Hello, everyone. I'm Bill Campbell, portfolio manager at DoubleLine Capital. Today is June 24th, and given the recent headlines that have been keeping us all captivated over the past several weeks and months, we thought this would be a good time to discuss with you how we at DoubleLine are managing our investor capital through all of the increased uncertainty that we've seen as of late. The past week, we have seen an increase in geopolitical volatility. In addition to that, we have continued concerns on the outlook for trade negotiations with the US and its other partners. We have also seen announcements from Secretary Bessent and others in the administration that trade deals will be reached fairly quickly after the budget deal is reached on July 4th. And when we look at the outlook for the fiscal and the outlook for trade deals to be done by these July 4th and July 9th dates, we find those very aggressive timelines and wouldn't be surprised to see more twists and turns in the coming weeks and months ahead. Trading these headlines for many investors can be extremely difficult and extremely frustrating. At DoubleLine, instead of trading day to day and headline to headline, we focus more on the medium term outlook and the structural trends that underpin the broader moves in markets. When I say medium term outlook, we tend to look 12 to 18 months ahead and we try to find themes and trends that will drive markets over this time period rather than the shorter term cyclical movements that can last 2 weeks to maybe a month or two. A lot of the headlines that we see today are causing cyclical gyrations around the broader structural trends that are at play. Instead of being tied to one specific point of the curve, like the long end of the interest rate curve, as an active manager, we can target any point of the curve. Currently, we believe that the front end to the belly provides the most value, as if things do go wrong, the Fed will cut interest rates and you will get capital appreciation. In addition to being able to target points along the curve and move our duration exposure from short to long, an additional strategy that active managers can engage in where they are provided the leniency is to short different points of the curve. For now, where we're able to, we like to be short or underweight the long end of the interest rate curve. As an active fixed income manager, we have teams of analysts that are looking at companies and are looking at countries and they're looking at various different fixed income instruments to identify value relative to the fundamentals. In addition to being able to allocate capital inside of sectors between credits, we can also move capital between sectors. As an active manager and an institutional active manager, we have access to many different fixed income sectors, some of which are difficult to index against. This gives the investor additional sources of diversification that otherwise wouldn't be available to them in passive or indexed strategies. For the past 20 years, the US investors have benefited from a rising dollar. Going forward, with the expectation that the dollar is likely to weaken, we think that US investors and global investors should have a larger allocation of their overall portfolio allocations in the international bucket, whether it's the fixed income bucket or even the equity bucket. Some of the reasons why we think that the dollar is going to go lower is that one, there's a massive amount of foreign investment that sits in the United States. And a lot of that investment came here because there was nowhere else to go. We think that given the increased uncertainty with the US fiscal outlook, the increased uncertainty with the US geopolitical outlook, and uncertainty with the US growth outlook, these investments might be reallocated to other countries, but outside of the US dollar. This will weaken the dollar, but will also provide a potential growth benefit to the country that's receiving the inflow. As US consumers purchase international assets, if those dollars are not reinvested in US markets, that puts a natural downward pressure on the dollar. And the US is not alone in having fiscal concerns and a challenged fiscal outlook. Many countries, from the UK to Japan to several European countries, face difficult fiscal positions and high debt to GDP burdens at the moment. And those need to be factored into international investment considerations as well. Given the increased uncertainties around trade, geopolitics, and even US policy, we believe that active management is going to be more important than ever in portfolio construction, especially given the long term use of passive beta strategies that have relied on the long end of the US Treasury curve. If you have any additional questions, please reach out to us at DoubleLine.